Hello financial fans, welcome back to another stock analysis. Today we'll be covering Lowe's company stock ticker LOW. Lowe's is a well-known retail company that focuses on providing a comprehensive range of home improvement products and services. With a strong presence in the market, Lowe's offers a diverse selection of high-quality merchandise for various aspects of home renovation, maintenance and decoration. Their extensive inventory includes appliances, tools, building materials, furniture and more. Customers can rely on Lowe's for both do-it-yourself project and professional contractor needs. Additionally, Lowe's aims to enhance the overall shopping experience by providing expert advice, design assistance, and installation services to help customers bring their home improvement visions to life. The company is currently sitting at a market cap of $128 billion, and in 2022 they generated a revenue of $97 billion, and their dividend yield is currently sitting at 2.04%. And they're a dividend aristocrat with 48 years of dividend increases, out of the 25 years required to be a dividend aristocrat. 95% of their revenue comes from products, 3% from services, and 2% from other various income streams, and 94% of their revenue comes from the US, and 6% is international. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. And we'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease will be determined by using a scale. We're using 4 colors in our scale. Bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. We're using 3 colors. Bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $8.5 billion in 2013 to $10.3 billion in 2022. The average EBIT growth during these years has been 14.3% on average, which is a 5% deduction from margin of safety. The margin has gone down over the years, going from 16% in 2013 to 11% in 2022. The average margin decline was 4%, which is a 5% increase in the margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up over the years, going from 64 cents a share in 2012 to $4.40 a share in 2023. The average dividend growth was 21% annually, which is a 10% deduction in the margin of safety. This with a payout ratio that is sitting at 41%, which is no change in the margin of safety on this metric. The final two metrics that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. And for Lowe's, this is just over 2.5 years, in this case, the 255% debt to EBITDA ratio, which is no change in the margin of safety. The return on invested capital for Lowe's is sitting at 23.2%, indicating that the management is very effective at allocating capital, which awards them with a 5% deduction from a margin of safety. Looking pretty good so far for Lowe's. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model we'll be using is the discounted cash flow model. I've imported free cash flow of Lowe's going from 2014 to 2022. The average growth in their free cash flow annually during this period was 21.5%, and I'm projecting an expected growth rate in their future free cash flow of 8% annually for the next 10 years. With this percentage, we'll determine the future free cash flow for Lowe's and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%, giving them a sum of free cash flow of $172.5 billion. To get an equity value, we have to then add the cash and equivalents and subtract the debt, giving us an equity value of $136.2 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $232.54, which is a 4% upside out of this model. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of Lowe's come from 4 years ago to the current year. The average growth rate in the dividends during this period was 19.61%, and I'm projecting an expected growth rate in all of their future dividends of 7%. I will once again be using the discount rate of 8.5% in this valuation once again, giving us a dividend discount model price per share of $313.87, which is a 40.39% upside out of this model. The next model that we'll be using is Graham's revised valuation formula. In this model, we'll take a look at the earnings per share that Lowe's is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE of a company with no growth shouldn't exceed 7. And looking at all of these metrics, we get a fair value of $135.98, which is a 39.18% downside out of this model. The fourth model that we'll be using is the multiple valuation. In this model, we'll take a look at similar companies to Lowe's, take a look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 20.54. Multiplying this with the earnings per share sitting at $10.46, we get a fair value of this model of $214.83, which is a 3.91% downside from the current price. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. I've imported the dividend yield of the past 5 years, and on average it has been sitting at 1.68%, while the current yield is sitting at 2.05%, indicating on this metric that it's currently undervalued. Doing the same with the PE ratio, on average in the past 5 years it has been sitting at 20.39, while the current PE ratio is sitting at 20.84, indicating that's trading pretty close to fair value on this metric, giving us a fair value of this model of $245.44, which is a 9.79% upside from the current price. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at a final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $228.53. A margin of safety we've determined earlier using a standard margin of safety of 25%, deducting about 5% for the EBIT growth, adding 5% for the margin growth, deducting about 5% for return on invested capital, and deducting about 10% for the dividend growth, leaving us with a 10% margin of safety. And applying this margin of safety, we get a fair value of $205.68. And with the current price of $223.56, we get a downside of 8%, indicating that's currently a slight sell, or more so a hold, you could say. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.